We shall now kickstart the workshop for the first technical session. The topics being covered are ICDS1 and ICDS2. The workshop coordinator, CA Gururaj Acharya, is the speaker for the first technical session as well. Over to Gururaj Acharya.
Good morning once again to all of you. I have a great support from my principal. I never expected that income tax department would be so proactive in listening and upgrading their skills ahead of times. And as she was saying that for us it is this year, for them it is next year. Maybe a couple of years down the line. In fact, right now when the income tax department is assessing for assessment year 13-14, they need to know only 13-14. Now whenever I discuss about the budgets with the immediate impact of the union budget with the departmental people, they say we will listen to your lecture on union budget 2 or 3 years down the line, not immediate. Because for us what we need to know is, always it's only a postmortem in that sense. So, madam, I take your presence as a great inspiration, and wherever I am wrong, you have the right and liberty to correct me and give your points of view. So, as I was saying in my inaugural session, that the standard plays a great role in acting as a balance between those people who want to curb the taxes and those people who want to show a very high profit. So it acts as a fine balance. So that's why this particular theme I chose for this particular income computation and disclosure standards. Now, the courts have always held that accounting standard is supreme. The courts have always held that accounting standards have been supreme, and there are a lot of Supreme Court decisions like the famous Bokaro Steels case and also the Challapalli Sugars Limited. And I always tell in my own way that the Supreme Court has been sweet enough to say in Challapalli Sugars case, and the Supreme Court has been strong enough to say in the case of Bokaro Steels, sweet as a sugar and strong as a steel, in these two cases, that accounting standards have to be given its due respect when it comes to computation of income also. Now, having said that, the Supreme Court also went on to say in the Tutican alkali chemicals and fertilizers case that whenever there are chemicals and fertilizers in the Income Tax Act, I will say specific provisions in the Income Tax Act, so those provisions has to be respected over and above what is told in the accounting standards. So what remains is accounting standards are supreme as long as there are no contrary provisions built in the Income Tax Act. So that is how the scheme of things have been there for a very long time. So that means the specific provisions of Income Tax Act always override that which is there in the accounting standards. Now when there are no specific provisions in the Income Tax Act, of course you have to follow the accounting standards. So that is very clear to all of us. Now that gets us to a very interesting question as how many accounting standards are there? Now how many accounting standards are there? Now left to itself, we may probably say there are 29 accounting standards or 32 accounting standards or whatever. But let me tell you that today I am not talking about how many in that sense. I am talking about the different set of accounting standards itself, given out by different authorities. For quite some time, when I was a student of CA, we had only one accounting standards issued by the Institute of Chartered Accountants of India, applicable only to the chartered accountants. I mean, that was the very ironical thing to happen, applicable only to the chartered accountants. Because our institute cannot bind the assessees. Just like, we don't have the powers that you have in that sense. So we were only saying that in case you don't follow, I am bound to qualify and say that you have not followed. They said, what? I am bound to qualify. Okay, you are going to qualify my financial statements, very good. My financial audit report comes with a qualification. They don't even understand what is a qualification. A qualification is a disqualification in that sense. So they say you are qualifying audit report, do whatever you want, but I am not going to follow the accounting standards. Now tell me one thing, if by following the accounting standard, mera tax kam hoga kya? That is the answer that we get. I don't say, but if you follow correctly, maybe it will go up, then you say you qualify. Doesn't matter. So that used to be the thing. So accounting standards issued by the Institute of Chartered Accountants of India. Then accounting standards in 2006. In 2006, accounting standards were brought inside the Companies Act rules. So there came out what is known as Companies Accounting Standard Rules 2006. wherein they imported more or less whatever has been told in our accounting standards into this particular, they gave a statutory recognition for the accounting standards told by the Institute of Chartered Accountants of India, and there came in a Companies Accounting Standard Rules 2006, which is prevalent even today in spite of the Companies Act 2013. Companies Act 2013, Rule 7 of Chapter 9 says that whatever is told in Companies Act, Companies Rules 2006 is also true in the present regime. So, but to whom is this applicable? Again, this is applicable only to the corporates. And is there any difference between accounting standard under the Companies Act and the Institute of Chartered Accountants of India? Almost nothing. But then there came in companies who had to follow IFRS. Companies which are listed abroad have to follow the international financial reporting standards. But in any case, all those companies were preparing the financial statements as per the accounting standards issued in India. So there was no problem with IFRS. What has happened? The precursor to the issue of ICDS I am telling is the introduction of Ind AS. And what is this Ind AS we are talking of? Ind AS is the, IFRS, we decided we are going to take on IFRS in a big way. We are going to take on IFRS. Should we adopt it or should we converge towards it? So we did not adopt it as such. If we were to adopt the IFRS as such, we would have said that we are complying with IFRS itself. But what happened is, we said we are not going to adopt what is told in IFRS, rather we will converge towards IFRS. So when we said we converge towards IFRS, that cannot be called IFRS. So they said we will now call that accounting standard which is converged to IFRS as Indian accounting standards, in short Ind AS. So the Ind AS is the converged IFRS suiting to the Indian tastes. Is it different from what is told in the first two, that is accounting standard of ICI and accounting standard of very much? I can give you a small example. Now if I sold some item to Mr. Ravindra at 100 rupees and if I sold something to Mr. Pampana at 110 rupees, that is because Pampana is paying me 110 after 1 year and Ravindra is paying me immediate. Ravindra is paying me immediate. Now as far as the Indian accounting standards are concerned, I will take both 100 as revenue and 110 as revenue. In the IFRS or in Ind AS also, they say because of the time gap involved in the payment, you are building an additional revenue there, and that incremental revenue is what is the interest element within the turnover, so therefore segregate that. So I will consider my revenue as 100 and my interest income as 10, which is to be accounted over a period of, if it is spread between 2 or 3 years, I will have to account this 10 or 20 or whatever it is over a period of time. So there is a very great difference like this. Then for whatever in case of IFRS or Ind AS also, we will have to go in for fair value accounting. We have to go in for discounting. Now there are a lot of changes which are there between the accounting standards which we have been following and Ind AS which we are going to follow. So there are a lot of changes. So when is this Ind AS going to come into play and for whom? These are the two questions which we need to answer at this point in time. Ind AS is applicable for all those corporates and listed entities who have a net worth of more than 500 crores from next year and net worth of more than 250 crores from the year thereafter. So from the financial year 16-17, for 15-16 it is optional. Anybody wants to follow Ind AS, it is optional. And whenever it is optional, you know nobody follows. That's one of the points. But having said that, I would always say for 15-16 you should start moving towards it, because when 16-17 comes into play, 15-16 becomes the previous year. So and Ind AS previous year is also important. So that is why, so you have to start doing this very parallelly. From next year you can adopt only the Ind AS. So for the next year, only for those corporates who have a net worth of more than 500 crores, holding subsidiary, associates and joint ventures of these companies will have to comply with the Ind AS. Year after that, financial year 17-18, all corporates having a net worth of more than 250 crores and all listed entities holding subsidiary, associates and joint ventures of that company has to comply with this. Now what has happened to the income tax department is, now imagine a company coming out with Ind AS and a company coming out with an accounting standard. Maybe it is for the purpose of applying a MAT, maybe for the purpose of computing the real income, net profit as per profit and loss account. Now there it would be something, here it would be something. So they said, if there are so many standards, then that is not a standard in itself. So for our own limited purpose, we will come out with our own accounting standards, and that is what initially came out as tax accounting standards, which they rechristened as ICDS. Now why was TCS called ICDS? In fact, in 2012 or so, I spoke about TAS in Karnataka State Chartered Accountants Conference, where the draft TAS was discussed. The draft TAS, tax accounting standard. The word accounting there was a misnomer. Misnomer because the accounting standard told by the department is not asking me to prepare my books of accounts according to the standards. Whereas all other accounting standards want me the recognition, disclosure, the measurement, all these things, especially the recognition aspect, I would say. The recognition, disclosure, presentation is not prescribed in the tax accounting standards. They are talking about only how to compute your taxes, taxable income in particular. So they therefore rechristened it as income, computation and disclosure standards. In fact, some of them are calling it as, madam, if you were not to be there, I would have told, but can I say something now in your presence? They also call it as income, confusion and distortion standards. So that is one of the names that they say. But having said that, income, computation and disclosure standards is what we are going to talk about. Now, who has come out with this? CBDT has come out with has prescribed a separate framework. This is a separate framework. In fact, only this much. This is the printed version of what I have. Right? I have made an analysis, I come to that. So tax accounting standard issued in August 2012. Tax accounting standard had detailed contents like, when they issued the tax accounting standard, it had very detailed contents like the background, the approach, other terms of reference, reasons for not considering certain accounting standards in the tax accounting standards. Now we have 29 or 32 accounting standards. 29 in the company's accounting standard rules and 32 in the Institute of Chartered Accountants of India's accounting standards. Whereas what we have here is only 10. Only 10 accounting standards have been considered by CBDT. Now why they have not considered others was also told in the tax accounting standards. Now they don't tell anything. So now in accounting standards, in ICDS, it is pure standards. They're just talking about what is the spirit or what is to be followed. The budget 2014, last time when Mr. Arun Jaitley talked about, announced and renamed the tax accounting standards to ICDS. Why? I just now told you the reason. They never wanted accounting to be based on this. Only the computation was supposed to be done based on this. Draft ICDS was issued in January 2015. That is what Madam was mentioning. The draft came out in January 2015 and almost no changes were there by the time they adopted the 31/3/2015. This notification is dated the 31st of March 2015. This is the notification which is containing the gist of the 10 accounting standards. The accounting standards. Now when I am talking about accounting standards, I wish, can you get the accounting standards of the institute? So accounting standards of the institute, the red book which we generally have. Then there is a red book, there is a blue book and there is now a white book. Red book is what is given by the institute. That is the accounting standards given by the institute. Each has certain matters in bold. Then certain plain type explanations. It gives a lot of explanations, examples and illustrations. It also has the concise aspect of the standard again repeated under the main principles wherein all paras are in bold. Okay? So that is how our accounting standards have been there. Now in this accounting standards, there is no repetition. It is only once. What is to be told once is told only once, and it is in very simple terms and to the point. I wish our accounting standards are also made that way. Probably now they can make it simple because when our accounting standards came, we wanted to explain with a lot of illustration, things like that. So we have already been used to that. Now making this, when we read this, we can understand things better because of that entry level understanding at that stage. ICDS is not verbatim reproduction of accounting standards. Madam was mentioning about AS1 and AS5, which was there as NAS1 and NAS2. So this was a verbatim reproduction of what was told in our accounting standards, whereas what is told now is not a verbatim reproduction of what is told in ICDS. So this is in budget July 2010-2014. Mr. Arun Jaitley said there is an urgent need to converge current Indian accounting standards with IFRS. I propose for adoption of the new Indian accounting standards called as the Ind AS by the Indian companies from financial year 15-16 voluntarily and from 16-17 on a mandatory basis. 500 crores net worth and thereafter 250 crores. So in short, companies which have 250 crores and above net worth have to follow Ind AS. Based on the international consensus, the regulators will separately notify the date of implementation of Ind AS to the banks, insurance companies, etc. Standards for computation of tax would be notified separately. So he told this in July 2010-2014, January 2015 there was a draft, and March 2015 there was a final notification. So this dates I have already mentioned. ICDS background, 145.2 we have already talked about, AS1, AS5. Assessing officer, in 145.2 also talks about AS1, the powers of the government, and it also says assessing officer not satisfied with the correctness or completeness of the accounts or notified accounting standards not followed regularly has the power to do the best judgment assessment under section 144. So that means not complying with the accounting standards. Now I would say these 10 accounting standards would lead to rejection of the books of accounts by the assessing officer and for doing a best judgment assessment under section 144. Now CBDT constituted accounting standards committee in 2010. Reference was given to them suggesting what they have to do. This is the final notified 10 accounting standards. What are the 10 notified accounting standards that they have notified? AS1, ICDS1, disclosure of accounting policies. Now you can see the number of pages. ICAS accounting standard runs into 7 pages, whereas ICDS runs into just 3 pages. In total, if you see the 10 accounting standards, what was 270 pages is only 77 pages. So what was more to read is only less to read. But probably this less of reading will lead to more of tax outflows. That is the implication of that. Now having said that, so disclosure of accounting policies, valuation of inventory, these 2 standards I will be talking in depth. Then we have construction contracts and revenue recognition, which Mr. Padam Kincha will be talking in detail. Then tangible fixed assets, Sachin I suppose will be talking on that. Effects of changes in foreign exchange, Mr. Shyam Ramadhyani. Government grants, Sachin. Securities and borrowing costs by Shyam Ramadhyani. And provisions, contingent liabilities and contingent assets. Again, Shyam will be talking on this. So these are all the various standards which have been notified. Accounting standards not in ICDS, accounting standard 3, cash flow statement, and accounting standard 7. What is accounting standard 7? Accounting standard 7, construction contract, sorry, 17, that's why the 7 is there, so I read it as 7. So 17, accounting standard 17, segment reporting. Segment reporting is not required for the income tax department. They said these are only disclosures, so we are not going to take that. Now there are specific provisions in the Act. AS6, depreciation. We have a section 32 which controls every depreciation, therefore they said we are not coming out with the standards on that. Accounting standard 14 on amalgamations, there are so many sections for amalgamations, we will not comment on that. Accounting standard 15 on employee cost. There are various sections, 36, 40A, 9, 43BF, 35 DDA, voluntary retirement schemes, so we don't have that. The accounting standard 18, related party transactions. There is a 40A 2B and a transfer pricing 92 specified domestic transaction between related parties. We have sections to control that, so therefore we are not talking about those standards. ICDS to be notified once accounting standard becomes mandatory. 30, 31, 32, all about financial instruments will be discussed only when those standards become mandatory. And then we have not relevant for the income tax department, accounting standard 20 on earning per share, accounting standard 21 on consolidation, 22. 22 is very interesting. Accounting standard 22 is all about taxes, not relevant for the tax department. It is on deferred taxes. Accounting standard 22 is on deferred taxes. Everything about income tax, but nothing relevant for the income tax department itself, because always deferred. No collection. Now I always say this, madam. Maybe when the department is very starved for funds, in the sense you have a big collection target, you can use the discounting concept of deferred tax and ask them to pay now. I know I get some brickbat from my members afterwards for that idea. The deferred taxes are only in the books, and therefore they have got nothing to do with the departments, and therefore there is no impact for the department, therefore no standards there. Accounting standard 23, accounting for the investments in the associates when you do the consolidation, not relevant. Accounting standard 24, discontinuing operations, 25, interim financials, 27, joint ventures, and 28, impairment. Has got no role to play in income tax, so therefore there is no standards on that. Accounting standard 4 and 5 was in TAS, but now dropped, maybe after some time it could come in. Accounting standard 19 on leases and 26 on intangibles, probably may be issued later. So this is the introduction. The applicability of ICDS, as Madam said, already applicable from 1st of April 2015. Assessment year 16-17, which is already in O. Immediate impact for payment of advance taxes. We've already done with how many advance taxes? As far as corporates are concerned, June and September. So December and March, at least for those who have not complied with, we'll have to comply with this. For accounting of tax expense, as I was talking about, for the purpose of accounting standard 22 itself, one has to consider the impact of ICDS when you do the quarterly or interim financial statements. Supersedes earlier notification issued in 1996. Applicable to, whom all is it applicable to? All assessees following mercantile system. Now this is very important. All assessees following mercantile system, not applicable to assessees following the cash system. Now this year you will see lot of assessees moving from mercantile system to cash system just to make a better ICDS planning. Okay? That is one of the possibilities that could happen, because for those who are following the cash system, for them there is no concept of accrual. So therefore when accrual is not there, no other standard can come into picture for them. So for those who are following the cash system of accounting, there is no requirement. Can companies follow cash system of accounting?
No.
Can companies follow cash system of accounting?
No.
Why no?
Companies Act insists.
The Companies Act insists. Companies Act insists that every company should follow accrual system of accounting, double entry system of accounting. But Income Tax Act does not restrict. In fact, there was an idea like that thrown out for all of us to do a research, that when it comes to companies, whatever is told in my profit and loss account, I am not paying my income tax on that. There are certain additions and deductions. Okay. Having said that, I can always have a cash-based of accounting even for the companies, and have this as a starting point, and whatever is told here, for the Companies Act I present this, for the Income Tax Act I present this. So there is a view like this. I don't know if there is any case law, any of the learned members here should say that, but having said that, this is the point of thinking. Mr. Madhavamurthy is very upset with my statement, but then, but this is a point of view, which I thought as a fine balance, I have to bring the point before you. Okay. So for all those following mercantile system of accounting, ICDS will be applicable. Is it applicable for all the 5 heads of income? No, it is applicable only for the third, the business income and income from other sources. So only for those who are following these two, having these two incomes, only are driven by ICDS. And very clearly, this is for computation of income and not for the purpose of maintenance of the books of accounts. And this has been told as a preamble in all the 10 standards. In all the 10 standards, this word saying that this is only for computation of income and not for the purpose of maintenance of the books of accounts. What are the general features of ICDS? The general features of ICDS is no optional treatment as permitted in certain accounting standards. In certain accounting standards, we have an option which is given to us. You may either follow this or you may follow that. No option like that has been told in, for example, under the revenue recognition. For service revenue, I have the option of either following the completed contract method or the percentage of completion method. Now, ICDS says you have to follow the percentage of completion method even for service contracts. So you don't have an option. Well, certain options like following the, when it comes to inventory, following either the FIFO or the weighted average method, that option is permitted even in ICDS, but certain options have greatly been reduced in ICDS. So no option for using the completed contract method for service transaction, must do using PCM. No option for valuing security on individual basis. Now let us say I have shares of Infosys and shares of Wipro. I have bought this at a particular price, and if I do the cost or net realizable value, I'm just saying company A and company B, I bought it at 100 rupees and today it is valued at 80. Cost or net realizable value, whichever is lower, 80. But here, company B, if it is 100 and 120, so I'll keep it at 100. So in the accounts book, there is a possibility of me recording a loss of 20 for company A, and for B, no loss. But when it comes to income tax, ICDS, they say you have to measure the cost or net recoverable value, or what the fair value we talk about in securities, on the basket basis. What we mean by basket basis is, you will have to put all the shares in one basket. Now it is 180, so 100 and 120. If you look in the totality, you have not lost. So therefore the losses will not be allowed. So the basket approach is taken when it comes to securities. Mr. Sachin will be talking about that, or Shabam will be talking about that in detail. So the ICDS uses previous year instead of financial year. Now, in all the cases they have been using the word previous year, whereas what has been told in our accounting standards is the financial year. Person instead of enterprise. These are all small, I would say, dictionary effects or the word effects. Person instead of the enterprise. Income of business, profession or vocation instead of profit and loss. Should. This standard categorically says should instead of shall, may and usually. That means, there is no choice. The words used in the standards here probably give to, there is a possibility of doing that or this. Now here they have been very vehement in saying shall, should. So that's what is told there. ICDS generally do not have, the following is the fundamental assumption. Prudence, don't be prudent, be very bold, is what the department says. Because this is what is told as no prudence is permitted. That means as chartered accountants we always have been told that whenever you foresee a loss, you account for it right now. You account for it right now. And if you see a profit, let it happen and then you account for it. That is the concept of prudence. But when it comes to the ICDS, they say don't be prudent. If you are foreseeing a loss, for us every year is a compartment, is a detachable compartment. If you feel that there is going to be a loss 1 year or 2 years down the line, let the loss happen and then you take it into account. So that is what the ICDS is saying, which is opposite to what our standard says. Now you must understand the reason for that is we say that we are warning the reader of the financial statements that there is going to be a loss. So be warned about it is what we say in our accounting standards. In ICDS, warning is not the criteria, tax collection is the criteria, and because every year is a compartment. So from that perspective, materiality is again not a point considered in ICDS. That means even if the item is very small, if it is insignificant, we may sometimes say, if I bought a calculator, if I bought a, let us say, an iPad costing 40,000 rupees or 50,000 rupees, an iPhone, a big company, I can write it off as a expenditure because it's not material here. So that's the point that I would use. But when it comes to ICDS, they say materiality is not of any consequence. Every item, if it is a capital, it should go to capital. If it is, so materiality is given a go by in ICDS. Accounting of foreseeable losses not permitted even for construction contracts. Accordingly, in several situations, ICDS would result in earlier recognition of income or later recognition of expense as compared to the accounting standards. So we have always seen this, that ICDS could lead to preponement of tax payments. That impact on the timing of tax related cash outflows. Unlike accounting standards, every ICDS has preamble stating this is for computation of income and not for maintenance of books of accounts. Provision of and then also in every standard they say provision of the Income Tax Act as supreme. The provision of the Income Tax Act as supreme, and if there is something told here which is in difference with what is told in the Income Tax Act, this shall prevail. This shall prevail. I mean, there could be a situation when in the future budgets or future finance acts this changes. So this says that we are secondary to the Income Tax Act itself. So
this is supplementary. This is to assist the income tax.
As is the Income Tax Department. Yes. Anything else?
No.
So preface, absolutely, as Madam was saying, that this is only acting as a support to the department. The primary Bible, the Bhagavad Gita, is the Act itself. So transitional provision in 9 ICDS, except in securities, transitional provisions have been built up to facilitate first-time adoption and consideration of resultant impact. Overarching principle is no income would escape tax, nor would it suffer double taxation on transition. So that is the principle there. Retrospective catch-up at the date of transition in certain cases, whereas in certain other cases, the provision applies only on the prospective basis. Under definition paragraphs, they have used word and expressions used and not defined under ICDS, but defined in the Income Tax Act shall have the meaning assigned to in the Act. If certain words are not defined here, go to the reading of that in the Act. Disclosure requirement. Now, ICDS talks about disclosure. The biggest, Madam, I think we would like you to carry our issue there, saying that they say that disclosure has to be done, but we don't know where the disclosure has to be made. Because financial statements I would have signed off.
Computation of income.
So where is that? So should it be in the computation of income? Should it be therefore or in the tax audit report? I would personally feel it should be in the computation of income signed by the assessee itself. And maybe definitely the department will now revise the 3CD format to say that has the assessee complied with all the 145(2) requirements. So that would be the way forward. So, yes, please.
See, actually, to help the IQO to determine the income, we all have this 44AB report. I have been seeing, I have been posted in so many different parts of the country. Everywhere I notice 44AB, generally it's not very dependable, because most of the statements are qualified statements. It is as certified by the management, or the value of the stock, or the quantity of the stock as told, or certified by the management. Most of the items are filled up like that. So actually we do not get any real worth by seeing the 44AB report. So this time, if at all they come out with a modified 44AB for incorporating ICDS, I would request all of you to make a committing statement. Like you have to own up responsibility. Because you are signing the 44AB report, you also have to have accountability and responsibility for what you are certifying. Yeah, I would request you to give a clear statements instead of qualifying, either passing the burden on the assessee or the management.
We will move forward and say that MAT provisions, no clarity in ICDS as far as the MAT is concerned. Now you can have a situation like this, because of the computation of income, I have already got the taxes. And then later on, by virtue of MAT, I will be paying the tax, I will be showing the accounting income later on which I may have to pay MAT. So usually MAT, I pay MAT first and then pay the regular taxes. This could lead to a reversal of situations. And for all those companies which have paid MAT, they are eligible to take the credit of the payment of MAT in subsequent years. But when the reverse happens, that would be a very difficult situation because the payment is already done. So that would be an issue to be recorded. So with this, I come to the end of the general issues, and I am going to two of the specific standards. I have been asked to talk till 11:15. Maybe I'll go up to 11:30 or 11:15. Okay, 11:15. I will try to sum up the two standards in the maximum time possible. Disclosure of accounting policies. Now this, as I told you, any standard, the way I would approach is to talk about the accounting standards and then talk about the changes that are there in the standards, which will only be incremental, and all of us are already used to the accounting standards. So what is told in accounting standard first with respect to disclosure of accounting policy is the purpose of accounting standard 1, to promote better understanding, very clear, to facilitate comparison. Now, I would like to know, one company is following a straight line method of depreciation, another company is following the WDV method of depreciation, another following, such different methods are following. So if I have to compare it, I have to make the comparisons comparable. So I would like to therefore read the policy and then get into that. So facilitates comparison and bringing uniformity as far as possible. That is the purpose as told in accounting standard 1. Now, accounting policies prescribe the principles and methods. Now, what is the distinction between principles and methods? Inventory valuation, I say I follow the cost or net realizable value, whichever is lower. That is the principle. Which is the method I am adopting for valuing the cost? Either the FIFO method or the weighted average method. These are the permitted methods which are told. So the principles and methods of accounting policy. Availability of alternatives. I have various alternatives in front of me. Which is the alternative I have chosen is what is the purpose. Now, how do I select the accounting standard? I mean, how do I select the accounting policy? The accounting policy is very beautifully told that what should be the supreme when you choose the accounting policy. The supreme, of course, we have three things: prudence, substance over form, and materiality. The supreme would be true and fair. Now, whatever accounting policy you follow, the most important thing that should be borne in mind is that that accounting policy should lead to the reflection of the true and fair state of affairs, or the true and fair income of that particular assessee. So therefore, they underline the word true and fair. Then they go on to say, you can choose, in determining your accounting policy, you can have three factors. Factor number 1, prudence. That means you account for foreseeable losses today itself. And then other accounting standards, mind you. I am talking of the accounting standards told by this red book. Okay? This is now red and this is now redder. If I may say that. Okay? So prudence. Prudence is what is told there. Substance or form. When we say substance or form, that is exactly why we say in the case of a lease, especially in the case of financing lease. In the case of financing lease, we say that the owner, the legal owner of the asset is the lessor, but the real owner of the asset is the lessee, because he is using it with all the risks and rewards to himself, to the lessee. So therefore, the substance is that he gets the depreciation as far as AS 19 is concerned. So substance over form and materiality. I already discussed about these 3 points. So materiality, substance over form, and prudence. Now when we talk about these 3, I put these 2 things in blue because these 2 things, prudence and materiality, is not told in the ICDs. So that is the change, the incremental difference, if at all, between our standard and ICDS is that prudence and materiality cannot be considered as the choice for determining the accounting policy. Fundamental accounting assumptions, going concern, consistency, and accrual. We call it as a GAC or GCA, whichever. So going concern, you have to consider that the company is going on, the assessee, in this case the person, goes on for ever and ever. He will not stop his business in the foreseeable future. That is how it is told. Just a point of understanding. If I see that the concern is going to close down, this could be a situation which you would be probably coming across. So many companies are closing down. How do I account for it? Going concern is not there. If I say that the going concern is, if I don't tell anything, then I presume that going concern is there. If the going concern is affected, how do I account for the that particular going concern affecting? The very wonderful situation which we had to face in our office. So what we had to do is bring out all the assets and liabilities to its realizable values. Now bringing down assets is no problem. But let us say I have an asset of 100 lakhs and 100 crores in one of the companies, 100 crores, and all that they can realize is only 10 crores. and they have share capital and they have dues to the bank 80 crores. Now 100 crores, whatever they are going to receive is only 10 crores. So I can say 10 crores, I will bring it down to my net realizable value. Now what the expert advisory committee also has told on this particular point is the liabilities also have to be brought down to its net realizable value. Now this was a big issue that we had to have. I cannot bring my the liabilities to my net realizable value on a suo motu basis unless the bankers actually write off. So that was a practical situation. So when the going concern is affected, we have a real problem. I mean, that is not to do anything with the ICDS, but the ICDS permits these three assumptions of going concern, consistency and accrual. Disclosure required only if these are not followed. Now disclosure of accounting policies, significant accounting policies have to be disclosed. I underline the word significant there because what is significant becomes a big issue. Now some of the companies, we say that the transaction itself is not there, but they disclose the accounting policy. That is not right. When the transaction itself, let us say in a services company, there are no inventories. They say that inventories are measured at cost or net realizable value. But then I look into the financial statement, there are no inventories. I mean, this gives a, this actually diverts the attention from the reality. I would put it back. So I think it distorts the whole, again, I use the word distortion there. So it distorts the thought process. So therefore, they say that whatever is significant means whatever is significant to the financial statements. You may have that as an accounting policy, but disclose only that which is relevant with respect to the financial statements. As part of the financial statement. Where should it be disclosed? As part of the financial statement. So this is what is missing in ICDS. Because they say that we have to disclose the accounting policy where it is still not told. I think that is where we still have a gap in ICDS. In a single place, even this is not very clearly told in the ICDs. That means, what we mean is, you cannot have accounting policies scattered all over your financial statements. You cannot have depreciation below depreciation, you cannot have inventories below. The accounting policies have all got to be, so therefore, if you read the financial statements, strictly speaking, balance sheet, profit and loss account, notes, and then you have a significant accounting policy itself as a separate note, because it should all be in one particular place. Change in accounting policies having material effect in the current and or future periods will have to be told. This is what is told. I will tell slightly, ICDS talks slightly different about this, I will talk about that a bit later. Disclosure cannot remedy a wrong or inappropriate treatment of an item. Very important. If I am following cost or net realizable value, whichever is lower. Suppose I say I am following cost or selling price, whichever is lower. This is what I am doing. But following selling price method is not right. But I may say, boss, I have disclosed. No? I have disclosed. So the disclosure of a wrong will not make the wrong right. I mean, that's what is the message that is to be carried. Or suppose I say, I am following the LIFO method of inventory costing. Is it permitted? It is not permitted according to the standards. But just by disclosing, the wrong will not become right. That is the spirit of what is told in the accounting standards. So no changes in the, now I am coming to ICDS. As far as AS versus ICDS, ICDS I am saying no change in the fundamental accounting assumptions. Going concern, consistency and accrual continues. In fact, one of the issues that is brought out is whether accrual told in the accounting standard is the same as accrual told in Section 5 of the Income Tax Act. In my opinion, it should be the same. It cannot be different. So we just leave it at that. Now again, I am bringing out certain specifics of accounting policies. If you read ICDS, which is there on the right side, the accounting policies refer to the specific accounting principles and the methods of applying those principles adopted by a person. So this is what said, the accounting standards only talk about a person, whereas here we talk about enterprise. Now when we say a person, whereas the entire accounting, I am saying that all the accounting policies followed by the person is okay. What should have been actually told there is with respect to income from business and income from other sources. Suppose he has a capital gains or a house property income, to that extent, I am not commenting, so therefore accounting policies, if the person is not correct, accounting policy of the person with respect to these two heads only is what I am binding myself to. Whereas our accounting policies, the accounting policies of the institute is for the enterprise as a whole. So that is the point I wanted to drive in. Now then the other point that is told in the ICDS is accounting policies adopted by a person shall be such so as to represent a true and fair view of the state of affairs and the income of the business, profession or vocation. Now I am okay with this except the word state of affairs there. Now state of affairs refers to balance sheet, whereas I am restricting myself to statement of total income and not to the statement of affairs. So when they actually reproduce from our accounting standards here, it gives somewhere, that's what I meant by saying some amount of distortions built in. But anyway, I think we take it in the large hand. I think that needs clarification. So consideration in selection of accounting policy. This we have already seen. Prudence, substance over form, materiality, AS1 permits all these three things. ICDS permits only substance over form. And prudence, ICDS very specifically says it disallows recognition of expected or mark-to-market losses unless permitted by another ICDS. The problem we will have is when we mark-to-market and have a gain, should that be considered? When using the concept of prudence, we even don't take that into account for accounting purpose, so that we leave it at that. So eliminate the concept of prudence. Materiality is also. Materiality for selecting accounting policy is omitted. Change of accounting policy. In change of accounting policy is told in our accounting standards in AS5, not in AS1. So when can you change the accounting policy? That is what is told, that when it is required by a statute I can change it. When it is to fall in line with complying with an accounting standard, I can change the accounting policy. And if the change results in more appropriate presentation of financial statements. The third one is very important. I can change the accounting policy if it leads to a proper, appropriate presentation of financial statements. This word has been replaced in ICDS with a certain different wordings. They say the change in accounting policy merely for more appropriate presentation may not be in line with paragraph 5 of ICDS, and paragraph 5 of ICDS says an accounting policy shall not be changed without reasonable cost. The reasonable cost, change in statute could be a reasonable cost, compliance with accounting standards or ICDS is a reasonable cost, but just to fall more appropriate presentation of financial statements, unless you have a very good cost, you probably cannot take that argument. Now another point which is told in the top there is change to be disclosed in the year of change. As far as our accounting standards are concerned, ICDS says, and also in a year in which the material effect takes place for the first time. Welcome to Sachin, next speaker. And also in the year in which the material effect takes place for the first time. So what is meant by this is, you need not, you are not only bound to say, suppose I changed the method of inventory valuation from, let us say, FIFO method to weighted average, and this year I don't have any inventories, let us say. So therefore I changed it and I had no impact. According to our accounting standard, I'll have to say what is the change, I just leave it like that. ICDS says, for the first time, whenever the impact happens, you will have to, maybe it happens 3 years down the line, you need to say 3 years down the line that I had done changes in 3 years back, and now the impact of that, if I were to follow the FIFO method, it would have been so and so, the weighted average is so and so is what is to be told there. So transitional provision, all contracts or transactions existing on 1/4/2015 or entered on or after 1/4/2015 shall be dealt with in accordance with the provision of this standard. After taking into account the income, expense or loss, if any, recognized in respect of the said contract or transaction the previous year ending on or before 31/3/2015. That means, suppose you had done you have actually, let us say, you have already taken prudence into account in your accounting, and you have provided for the loss. You have already provided for the loss, which was also accepted by the department. And this year, when the actual loss happens, it will not be allowed again because you have already taken advantage of that loss in the earlier years. So this transitional provision is built in to take care of such situations. So that gets okay. The reporting requirement under clause 13D, I am very sure that it will change, especially point number D, clause number 13. Details of deviation, if any, in the method of accounting employed in the previous year from the accounting standards prescribed under 145 and the effect thereof on the profit or loss. Now this brings a very onerous responsibility on all the tax auditors, which Madam was also saying that we need to be very careful. That's where our reading and understanding of ICDS comes into play. When this says 145.2, all these days we just have to follow AS1 and AS5 and we complied with NAS1 and NAS2. So from now onwards we need to prepare a checklist and see what are the changes and then get into that before we comment on this. And this could be a very important aspect to be looked into, devoting a lot of our time to answer this particular query. I come to the second accounting standard 2, valuation of inventories. Anything else you want to comment? Valuation of inventories. A very, very important element in the financial statements. Madam is there, but I am sure Madam can understand this. Inventories play a very important role in the profits and therefore in the income and therefore in the taxes. In so many cases, the inventory valuation determines the taxes. So that I am sure. So that inventory valuation, if it is not right, the tax will not be the right figure. So therefore, there is a very important. This is a very important standard, and inventories are present in all companies. You agree? No. In service companies, it is not there. There are inventories in service companies. This is what is now told in the ICDS. ICDS says, even for service companies, you have to come out with closing stock of services. Very shocking, right? Where is closing stock of services? You should open a drum and saw. Sure. In this drum it is there. We have this particular thing of valuing the valuing the closing stock of power. In the power generation, BESCOM, let us say, closing stock of power. How do you measure closing stock of power? First of all, can there be a closing stock of power? All people from the scientific background will say, always power keeps moving, it cannot be stopped. It cannot be stopped and stopped. So, but then what is stock for the purpose of accounting is different from the point of view of the science man. Whatever is produced and not billed, whatever is serviced and not billed, now I am going to services, whatever is produced and not billed is your closing inventory. Because your production cost is there on this side. Your production cost is on this side. On this side, which now makes up for matching principles, you have what is produced and therefore the cost loaded and not billed. If it is billed, it is okay. If it is not billed, it will become closing stock of inventory or of services or of power. Now we are talking of power. Then we have to say, can I do a physical verification of that? He said, yes, you can. You can. How? You can touch and feel, and then the only thing is you may not be there afterwards. So that is another question. That would be the. Now, having said that, so the closing stock of inventories becomes a very, very crucial element when you work out the financial statements. AS2, objective. Yes, sir.
One of the service tax implication may not be there on.
I'm coming to that. It will have. It will have. In fact, that is one of the issues.
Because then the point of taxation will apply there.
Exactly. So objective. So therefore, service tax may come out with service tax disclosure and accounting standards. You be prepared for that. Objective. Determine value at which inventories are carried in the financial statements until related revenues are recognized. Until related revenues are recognized. Valuation principle, lower of cost and or net realizable. So this is the valuation principle, lower of cost and or net realizable value. What are the items? What is inventory? Inventory is defined as finished goods, work in progress, raw material. Not told in so beautiful words. They said whatever is meant for sale, whatever is meant for use, and whatever is in the process of being converted into finished goods. That we call technically as finished goods, work in progress and raw material. What are the excluded items? Now I am talking from accounting standards, mind you. In the excluded items, work in progress in construction contract is not included because AS7 takes care of that. Work in process in service providers is not told here. Work in progress in service providers is not told here, but this exception is not there in ICDS, which means the closing stock of service providers is also covered in inventory valuation. Shares, debentures and financial instruments is not covered as inventory because AS 13 covers that. Producers' inventories or livestock, etc. Trees, animals, and all these, agriculture based fisheries, these are not covered as inventory because there it is always valued at net realizable value, because if I have a tree which is growing, how to measure that? It's always at net recoverable value when I have an active market or a commitment for that. That's what is told there. So machinery spares is also not covered in AS2. Used with the tangible fixed asset, and their use is expected to be irregular. So we'll talk about that a bit later. So meaning of cost, we have purchase cost, conversion cost and other cost. Purchase cost will have purchase price, duties and taxes. I put duties and taxes in a red color there because this accounting standard says duties and taxes within bracket other than those which are subsequently claimable, which means the VATable taxes, the Sun VAT, the VAT itself will not form part of the purchase cost because I will be able to claim that. Whereas ICDS following 145, section 145, which says that purchases and inventories and sales will always be with the cost, and they don't use the word subsequently recoverable. That means all taxes, whether or not it is going to be subsequently recoverable, will form part of purchases and therefore form part of closing stock. Now here, our accounting standard follows the exclusive method of accounting of inventory valuation, whereas income tax and ICDS follows the inclusive method of inventory valuation. Let me be very clear, you follow any of these two methods, the impact on taxes or the accounting income and therefore the taxable income will be zero. So, yeah. So freight inwards, other expenses related to purchases, net of trade discounts, duty drawbacks, etc. Conversion cost, direct labor, other costs to bring to its present location and condition like design costs and non-production overheads. What is the meaning of net realizable value? Net realizable value is equal to estimated selling price minus estimated cost to complete minus estimated selling cost. This is told in the accounting standard. Item by item basis. Grouping similar or related items acceptable. Estimation of, you can estimate the net realizable value based on what you realized in the subsequent year up to the balance sheet signing date. Raw material valuation normally at cost. Valuation consideration, items excluded from the cost, abnormal cost, storage cost, admin cost, selling and distribution overheads. Very interestingly, I said and D is red, put in red. That means selling cost, if any selling cost should not be included in my inventory valuation. But distribution cost, if there is a distribution cost, let us say I produced this particular bottle at 7 rupees and took it to the godown and incurred another 1 rupee. Should I value it at 8 rupees or should I value it at 7 rupees? So should distribution cost be part of my inventory valuation or should it not be? Is the question. Accounting standard 2 says selling and distribution cost is not to be considered as a cost. In fact, very interestingly, there is an expert advisory opinion. So Sunil Gururaj, I think he will be able to reiterate this particular point. And distribution cost will not be included in the inventory valuation. Whereas there is an ESE opinion itself which says that transportation cost to bring the inventory to its present location should be included in. So I don't know, there is a succinct difference between distribution cost and transportation cost. Strictly speaking, if the goods are nearer to the point of sale, that cost should actually be loaded to the inventory. Whereas our accounting standard, distribution cost is to be excluded. And rightfully, international accounting standards don't exclude distribution cost in inventory, which means include distribution cost also in inventory, and ICDS follows IFRS. ICDS follows Ind AS. And so they exclude only selling cost and not the distribution cost. In effect, the inventory value will go up and therefore the taxes will go up. That will be the impact. So treatment of joint product and byproduct, ascertainment of cost, technique for measuring the cost. In fact, you can either follow the FIFO method or the weighted average method. Now when you are following any of these two methods, should you adopt the exact cost of purchase or can you adopt certain techniques? Now one of the techniques that we adopt in a retail house is I measure everything at I have, let us say I bought 1000 items and some 100 items are in stocks. So what I will do is 100 items I will take the purchase price. Either I can do the top down, go on working out what is the cost of purchase and cost of everything up to the date and work out, or I can do the bottom up, which means I take the selling price and go on deducting the margins, go on deducting the cost, incremental cost and the margins to be incurred, so I can work out the stock valuation. So that I call it as the retail method, which is prescribed in the accounting standard. So you can follow the retail method of inventory valuation for retail goods, which is also told in ICDS as a technique. And then standard cost. Now I can just say if the goods are completed 40% or if the goods are up to this particular stage, I can just say it is cost plus 20%, cost plus 30% or whatever standard cost I have already fixed. I can take that value for the purpose of arriving at, that's just a technique. Instead of going to the scientific value of numbering, I can take the technique to work out that particular inventory valuation. But what is now told in ICDS, whereas accounting standard permits me to follow any of these two techniques, either the standard costing method or the retail method for inventory valuation, ICDS permits only retail method and standard costing is not an accepted technique for ICDS. Okay? So finally, disclosure, accounting policy, cost formula, total carrying amount and appropriate classification. Now here are a couple of things. How do you work out the working process for service providers? Let me talk about accounting itself. How do we work out working process for service providers? This is excluded very clearly, and very interestingly, AS9 tells me for service providers I can follow two methods, either the completed contract method or the percentage of completion method. If I follow the completed contract method, let us say I have a huge assignment, ERP implementation or something. I am doing a huge assignment worth 12 crores, and what I did was, I started the job in January 2015, 12 months, 12 crores is my expected revenue. So on 31st of March 2015, how do I value this closing stock of? Closing stock I don't take into account. What does revenue recognition say? You can either follow the completed contract method or percentage of completion method. If I follow the completed contract method, I will go to recognize my revenue of 12 crores when it gets completed. Let us say December 2015 it gets completed. So I account for this entire 12 crores as revenue in December 2015. If I follow the percentage of completion method, and I assume that every month it is done on an equal basis, in March I will recognize 3 crores as revenue and the balance 9 crores I will recognize as revenue in the April to December. This is how it should be done. Now ICDS says you have to follow only the percentage of completion method. You cannot follow, that means you have to account 3 crores and you have to account 9 crores separately. So this is as far as accounting standard and ICDS. Let me bring in a new angle to it. Why am I talking revenue recognition in inventory valuation? Now my job is inventory valuation. Now in inventory valuation, there has been in I think 2006, Mr. Sunil again will be able to tell this, expert advisory committee. Expert advisory committee said very interesting thing. When you are following the completed contract method, you have incurred your costs in January, February, March. So you work out what is the cost. Should there be a closing stock of service in accounting when you are following the completed contract method? That is the question that was posed to the expert advisory committee. This is a committee, madam, which decides in the institute how the accounting has to be done. So the expert advisory committee went into this aspect and said, if you are following the completed contract method, you shall account the closing stock of inventories, of course at cost. So now am I clear? So if you are following the completed contract method, you would have probably incurred say 50 lakhs every year, every month. So your closing stock of inventory on 31st of March would be accounted as 1.5 crores. If you are to follow the revenue, 3 crores. If you are following the cost, it will be 1.5 crores. Am I clear?
Actuals.
It is actual because cost is cost of net realizable value, whichever is lower. So my cost is going to be 150 which I have incurred, so that will be the cost. Now the issue before us, if I follow EAC, opinion and now read it in the light of ICDS, ICDS says what? ICDS says you have to, in this particular case, follow the revenue under percentage of completion method. If I follow percentage of completion method, I will have 3 crores recognized. Now where is the question of recognizing the closing stock of that as on 31st of March? Because this was not required, is my point. In inventories, there will be no concept of closing stock of services because services invariably has to be measured under percentage of completion method. Yes, having said that, there is one very small, when I went into this deeper and deeper, I got to know one point that you don't recognize the, I think the law promoted something. Okay.
It is a related cost.
Sorry?
It is a related cost also should be recognized.
No, you see when you recognize 3 crores itself, no, I think I'll stop. It takes care of it. Absolutely. When you, 3 crores itself you are accounting. Where is the question of accounting another 1.5 crores afterwards? But they only, sorry?
When you are paying the 9 crores in income,
Yeah. No, 9 crores is in the next year, sir. There is no closing stock afterwards. Sorry?
when you are paying the inventory valuation,
Yeah.
where the cost in 3 crores this year,
Yeah.
9 crores will stock. So
No, sir. There is no 9 crores closing stock. It is only 3 crores ka closing stock. 9 crores will be incurred next year and therefore it will be revenue of next year. There is no closing stock of 9 crores. It is only closing orders on hand of 9 crores. Pending orders on hand 9 crores that will be available with me. Now having said this, so this particular 1.5 crores, there was no need. But one point is the construction contract as well as percentage of completion method when we say, you may be agreeing sir, that early stage completion. Whenever there is an early stage, you are still in very early stage, you have done only, and they have defined early stage at 25%. So if you have done only 25%, then there is an issue how you deal with that. You know, you don't have to recognize your revenues until you breach your early stage. Maybe up to that stage, your closing stock of inventory will come into picture. Okay? So I think I have to stop here. I will stop with the closing stock in hand. I may again come back to opening stock afterwards. We will break for tea, and I think the chairman has to.
Please give him a big hand.
Before I formally present the vote of thanks to the first technical session speaker, I request Ms. Nutan Vodiyar to kindly present her concluding remarks.
Mr. Shravan, I should thank you for giving a nice introduction in the beginning. I was really surprised how you corrected so many details. And now I am again thankful to you for giving me opportunity at the end of the program. See, this is an extremely interesting and illuminating and educative program where there is so much to learn from Mr. Acharya's session. He has studied in depth and he made everything so clear. It was so nice. After a long time, I was feeling nostalgic, of attending in a college, listening to a very good lecturer, taking you through, I was a student of economics. I was reminded of a teacher who was very good in his subject. And then it's a really such a happy and exciting event to be part of all these chartered accountants who take interest in keeping up to date and keeping pace with the developments in the country. And I'm really grateful to all of you for having invited me to be with you all. And I have a few things to say about my department. See, now we are focusing on tax widening. It's a very major target given to us this year. We need to have more number of assessees. And it's a very challenging targets are given to us. for increasing the number of assessees. So we heavily depend on you all. It's only with your cooperation and with your support and with your valuable guidance to the public that we can hope to have more assessees whom we can cover. So we count on you for counting more assessees this year. And one thing I would like to impress on all of you that now the department has become very, very assessee friendly. And it was not so earlier days, because I joined a few decades ago. Those were the different days. Now we have been transformed from notice regime to invitation regime. Now we don't give you notices. In fact, we invite you to come to office for a cup of tea. And we also have this. I'm holding additional charge of ICDSICDS of Karnataka and Goa. We do have so many programs for the. Actually, we have interactive sessions with the top defaulters. But when we invite them, we say they are top deductors. We don't call them as defaulters. Of course, top deductors only have got so many issues. And then we also invite the senior officers, like the senior commissioner of TDS from Ghaziabad, and the software persons also, like Infosys and TCS. And they all come from CPC Ghaziabad, Delhi, and they try to sort out the issues and address their grievances across the table. We have been doing that continuously. So I need your cooperation and your suggestions also. Your suggestions are most welcome. Recently there was one occasion, we also had a seminar for training the assessees to file their returns electronically. One day I was in my office, as I entered my office in the morning, one old gentleman was inquiring where to find the returns. I told him he was a salaried person, pensioner. It used to be an HMT building. Then he suggested, can I suggest you one thing? Why don't you have a training session for the pensioners to teach how to file return? Then I discussed with my colleagues, they all agreed. So we invited the team from the CPC Bangalore. So a team of officers came with a PowerPoint presentation, and separate program was organized basically for the senior citizens for e-filing the returns. And then recently we also had TDS conference in Delhi. And lot of issues are, TDS also we are trying to see, instead of making quarterly returns, we are trying to make it annually, annually returns can be filed, but it will go a long way. We may start with the salary in the beginning, salary returns to be filed annually. Slowly it may be extended to other TDS returns. So we are also conducting awareness programs in the rural areas also, and in the tier 2 cities like Davangere, Kulburga, Hubli, Ballari. So many places we have conducted awareness programs. So we need your suggestions also in this direction. And we are having one more thing, that school visits are also being organized. My junior officers go to these schools and they also try to explain to the students about the importance of income tax and about the necessity to pay income tax. And then they also go during parents-teachers meeting. There is weekly meeting is conducted so that they can interact with the parents and the teachers. And in turn, we also invite the school students to come to our office and go around the office and see how we function, and we take them to Ask Center and explain to them. So many things we are doing, but we want much more activity in this area. You all have such a great role in nation building, and especially this ICI has been an institute of great pride, and it has been so professional, and all the time it has been training the participants to update their knowledge of accounting, and there is some such difficulties which we are going to face in ICDS. Mr. Acharya has explained, I have noted those things, but I would also request him to give in writing if there are some more doubts or some difficulties which are anticipated in implementation of ICDS. He will take it forward. So this is all for our benefit only. I am thankful to all of you, and you have been such a alert and such a sincere participants, I would request all of you to give a big applause to yourselves. Thank you, Anil.
Thank you, madam, for your address to the gathering, and also thank you for the inputs that you gave as a part of the technical session. I would also like to thank CA Gururaj Acharya for actually laying the foundation stone for ICDS as such for the rest of the sessions today's workshop that you'll be facing through his deliberations on ICDS1, and also for sharing his knowledge on ICDS2 inventories. A big round of applause, ladies and gentlemen, to Gururaj Acharya.